money will flow elsewhere. It always does. In the past, whenever you look at the S&P in a bear market, if you look over at T-bonds, oh, it's a place to be. It actually goes up. Yields go down. Gold also. Those two are the alternatives. This time around, it isn't. It's only gold. T-bonds are stuck in a mire, not far from the high end of their rates or the low end of their price action. When the money flows, when you roll over again in the stock market, and I think we will, and I think you'll see the evidence of that probably early in this new quarter. When you start to see that rollover, watch the money flow, because I'm going to bet that it gooses gold and the monetary metals in a more exaggerated upside manner, more vertical rather than arm wrestling.
Historically, gold helps diversify a multi-asset portfolio to smooth risk and return and reduce overall losses when stocks, bonds, real estate, and other assets fall. The precious metals market is experiencing a historic transformation, with gold achieving its most significant breakout in 50 years and silver following closely behind. Global analyst MichaelOliver believes that once the market rolls over again, likely in the early third quarter, money will exit stocks and flood into gold. He expects the move into gold and monetary metals will be more vertical than arm wrestling. Surprisingly, gold still outperforms the stock market. That said, the margin is much smaller. Over the last decade, gold has averaged an annual return of 12.9%. The stock market's average annual return is 10.6%. There's one clear divergence during the COVID-19 pandemic. Gold outperforms during this time, but the stock market eventually catches up. Based on market trends, Oliver predicts that the recent new highs in the S&P and Nasdaq are deceptive and echo past market tops, such as those in 2000 and 2007. Furthermore, Oliver mentions that we're now in a similar setup, with his forecasted bounce to 4,800 for the S&P 500 and 16,500 for the Nasdaq playing out. But he warns the slow grind higher is a price trap, likely preceding a sharp downturn. As President Donald Trump has discussed implementing tariffs, the stock market has wavered. In April of this year, the stock market experienced a dip after President Trump implemented his tariff policy. This resulted in the Dow Jones Index losing over 4,000 points, the S&P 500 losing 10%, and the Nasdaq losing 11% over 2 days, according to the Wall Street Journal. The market lost $6.6 trillion, which was the largest two-day loss on record. As the tariff discussions continue, investors are worried that the worst is yet to come. What would happen if the stock market were to drop 50% in just one day? Before we dive into MichaelOliver's sharp insights from his latest interview with MarioInnecco, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
What happened in January on the S&P, barely coming off of its late 2024 high, it broke enough quarterly momentum trend structures in our work. Now, what does that mean, quarterly momentum? That's when we measure price in its relationship to a three-quarter average, which is a fairly long-term average. And it doesn't matter whether you're above or below the average necessarily. It's the structures that you build visually. When you look at the momentum chart, you see like what you see on a price chart, except usually price doesn't show it at that time. We broke major structure and we paid dues into April. The event started to unfold about a couple of months after our breakage point. I've even mentioned it in the reports that don't be surprised by a new high. It's highly, highly likely to be false, deceptive, and a trap. Okay. Now, when we go back, I said deja vu. Back in 2000, we had the dot-com top. At that point in time, in January, in fact, the first day of the year, we put out a report saying, get out, it's over. Okay. And we had a sharp break right after that. It dropped into like February, dropped like 10% or so. It was a pretty sharp break then. And by March, it came back up and made a marginal new high by a handful of percentage points. And so everybody thought, well, boy, is he wrong? We said, no, the structure was broken on momentum. Price is making a new high, but it's a trap. And it fiddled around up there either side of our January sell point. Again, this is the dot-com top. And in August, it finally went up and made a new high monthly close as well, not just an intra-month high. Still not very far from the January sell point, but holding. So naturally, anybody who's long, their fear is abated. Why? Because every time it tried to go down, it wouldn't go down. And therefore, oh, this is great, And then later in the year, it sagged off again. So by the end of the year, you're actually headed down a bit. And in January of 2001, the Fed would cut rates twice. They'd been on a hold pattern for over a year. I think, no, for a year. And then they started cutting rates twice in the same month. And you were already somewhat off the high at that point. And it's only then that the real bear market started to show itself in early 2001. And of course, it dropped 50%. NASDAQ 100 dropped 82%. Okay, huge bear. Okay, again, confusing and laborious high. Go back to 2007 now. Analysts who were sort of outside the mainstream of Wall Street who perceived, analyzed, and said, there's a problem here. It's a crisis. This mortgage situation is going to blow up. Nobody believed them. They were laughed at. It was a great movie in that regard. It was a true movie, too. Um, they must have been pounding their heads into the wall because they assessed the market in 2005, 2006, 2007 as it's no good. Okay. And it took till 2008 before they finally got, they were vindicated. But that's a laborious top. You made a high in May of 2007 at around 1550 plus a few points over 1550 on the S&P. By the way, the old 2000.com high for S&P was also 1550. Okay. We went up and basically they sold that high. You had a sharp drop into August. In other words, anybody who was looking for a top got a sharp drop. And then suddenly in August, it turns up. September, mid-September, the Fed cut rates in an ambush way. Nobody expected it. Half a point. About 3 weeks later, it pushed up into October and took out the May high. So what do you get? May, June, July, August, September, but 5 month span there. And which also took out the 2000-year price high. So on a price chart basis, you've got to be pounding the table. It got to 1575. 25 points or about 1% above those dual highs. So anybody looking at a price chart would say, oh boy, look, it's a breakout. Okay. That was it. Tombstone was placed right there. And then the bear market started. I mean, it really didn't unfold hard till later 2008. But again, complex top, meaning laborious, new high involved. But momentum says, it's not valid. It's a trap. We're in that same position now in our assessment. When the market broke, gave us our signal in January for the S&P and early March for the NASDAQ. We had the sharp drop, but we had, in MSA, we put out a report warning there's going to be a bounce point. And we defined it as 4,800 for the S&P and 16,500 for the NASDAQ 100. That's where they stopped, within decimals either side of those numbers, and rallied. And over the last, 2 months, it's been an inching type rally, where it's not been explosive, it's just been creepy crawly. And now over the last 48 hours, S&P and NASDAQ made new highs. So everybody's saying, oh boy, it's on CNBC, Fox Business. So everything's okay again, right? No, we argue, no, this is a trap, price trap. Momentum says you broke your shin bone and your hip bone in that recent break. And the next time you turn down, you're going to break your backbone. Do not trust this rally. Why is it significant? Money will flow elsewhere. It always does. In the past, whenever you look at the S&P in a bear market, if you look over at T-bonds, it's a place to be. It actually goes up. Yields go down. Gold also. Those two are the alternatives. This time around, it isn't. It's only gold. T-bonds are stuck in a mire, not far from the high end of their rates or the low end of their price action. So when the money flows, when you roll over again in the stock market, and I think we will, and I think you'll see the evidence of that probably early in this new quarter. Okay. When you start to see that rollover, watch the money flow, because I'm going to bet that it gooses gold and the monetary metals in a more exaggerated upside manner, more vertical rather than arm wrestling.
In his analysis, MichaelOliver expects silver to enter a strong acceleration phase, potentially reaching up to $70 within 2 quarters. Historically, gold-silver ratios suggest silver is still undervalued. As a result, he's focusing on silver and silver miners in his portfolio. Many analysts believe silver has room to go higher. Citi Research recently forecast that silver could reach $40 per ounce within the next 6 to 12 months, and possibly $46 by third quarter of this year if momentum continues. However, short-term pullbacks are still possible, especially if gold continues to weaken. Silver has broken out of a long-term range and held above a key technical level. With demand strong and gold softening, the outlook for silver remains bullish, at least for now. Silver has shown strong performance during conflicts and economic downturns. For example, in the 2008 crisis, silver prices jumped 120%, beating gold. This history supports adding silver coins to your portfolio during crises. Concurrently, Oliver notes that despite the dollar remaining near the 98 to 100 level since 2015, gold has tripled, indicating that the dollar is a poor indicator of gold's direction. He expects a breakdown in the dollar soon, which could support gold, but more importantly, trigger broader market shifts. Let's get back to the interview.
I think we've entered it for silver. As you noted, there were two highs at 35. One was last October and the other one was March, just prior to that puke drop we had when we dropped 2750 in early April, trying to act like, oh, I'm part of the stock market. Okay, which it isn't. Okay. Gold, meanwhile, during that drop, had a single percent drop. Silver had a $7.5 drop, most of that in 2.5 days, by the way. That cleansed the market, and you came back up. And when we got above 34 recently, we had, yeah, these are monthly bars here, yeah. You can see the dual highs at 35 there, that shelf there, yeah. And we got above that early in this month, and we defined about 34.90 as a breakout that would blow through the 35 level and get a triple top breakout, meaning you hit 35, back off, hit 35, and you hit 36 as a triple top breakout, right? Okay. So the price guys sort of woke up then. And for the last 4 weeks, it's been dull, dead, and firm, closing the weeks out basically at 36 or higher. For like, see, look at that. I mean, they're selling it, but it ain't going down. Okay. It's just sitting there taking it. And during this time, of course, the stock market's going up over the last 4 weeks. Silver hasn't. Who cares about silver anymore? We got the stock market. Okay. Uh, I think silver is about to launch in a way that will drop jaws. I don't think this launch is the end of the bull market. I think it's just an acceleration phase. My assessment, and this is technical, is that this acceleration phase is likely to blow through 50 very easily and maybe pause between 60 and 70. And that occurs in the next, within 2 quarters, probably even less time than that. So, but between now and the end of the year, I think during that time, gold will also go up, but it won't go up as much as silver on a percent basis. I think I sent you a chart in that regard.
Yeah, yeah, I've got it here.
It says a lot. This chart really does say a lot.
Let's get this chart up. This one?
It's not sophisticated. It's not momentum. All it is every single year, those graph bars show what is the highest reading of silver, divide an ounce into an ounce of gold, express it as a percent. And you can see there's a red line going through 21 of those 50 some odd years where it's at least 2% silver price divided into gold. And in bull trends, like in 79 and 80, when it went up to 6.5, or in 2011, when it went up over 3, it goes even higher than the 2%. Right now, we're just above 1.1. We're not at the high of that. That just shows through 2024. But we're moving up toward the upper end of those last three graph bars you see there, which are in the low 1% level. Okay. We analyze this on a closer up basis, and we argue that when you close a month out above 1.1%, right now we're toying with that number right now. Divide silver into gold, express it as a percent. Okay. We're using right now July silver during this month. We'll rotate to SEP next month, and August gold. Okay. Right now they're trading maybe even better today. I'm not sure. 1.1% area. You close a month out over that, and I think we're going to start a move that takes us up to that 2% level. If you bought a stock at $1.10 and it went to 2, you've almost doubled your money. And what this chart tells you is if we go back to a normal 2% level, it's not even, it's not rare at all.
Yeah, that's $60 silver.
Yeah,
Gold 3,000.
Yeah, gold go up another $1,000 and silver will be 60, 70, and if gold goes higher, which I think it will ultimately. But right now, my focus in my own portfolio, and we reveal this at the end of all our reports, we show what we own, is emphasis in silver and silver miners. I think that's the better place to be in the monetary metals category. It has not been the best place to be for the last couple of years because silver has, while it's gone up in price, it is underperformed on a percent basis the gains gold has produced. I think that's going to switch very quickly. If you go back on that dollar chart, you'll see that it had a surge high that got up to 100 back in late 2015 when gold made its low in December of 2015. You see that surge there, right there, yeah, right about there.
Yeah.
No, wait, yeah, that surge. You closed in December of that year when gold was making its low at 1,050.
I
The
remember that. Yeah.
dollar index was in the area of 98. Okay, where are you now? In that same area. So
Yeah.
in other words, if you're looking at the dollar as your sole metric to judge gold, you're wrong. Because
Yeah.
gold has doubled and almost tripled. No, it's tripled
Well, the low in
since 2000. Yet the dollar's not moved.
the low in 2008 was 70.69, and
Yeah,
gold is at
and when
1,030, and now gold is at 3,300.
yeah, and when gold made its low, which is in the middle of that chart, when you surged up to
Yeah.
the your level, right there, yeah, that's when gold made its bear low.
Yeah.
And since then, the dollar has oscillated to the side of that price, and gold has yet trended up sharply. So using the dollar as your primary
Yeah.
judgment method of gold is totally wrong. I think the breakage here in the dollar that we're going to get is a couple things. One, it will provide more wind for gold. It's not a primary driver, but it will help. But the other thing is, it was the quiet one during 2023 and 2024. It was in an 8% range. There was volatility in other markets, but the dollar was dead. There was no volatility, no waves impacting anything. Euro, yen, it was just all muck. Now suddenly the quiet one, I think, is waking up, or rather down, and that will create wave effects in other markets.
Continued deterioration in global bond markets could accelerate the move into precious metals as traditional fixed income investments lose their appeal, affecting the dynamics of gold bonds and economic cycles. With rising geopolitical and economic volatility, will gold become the standout asset of the next financial storm? And are you positioned for that shift? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos.